What are you guys telling your clients at BlackRock at this point?
Well, we're telling them that right now, the bottom is uncertain. You've got a hard to quantify risk. None of us are epidemiologists, but, there are some silver linings. Valuations have come way down. And as we found out this morning, the basic structure of the U.S. economy is sound. We don't know the effect of the virus, but we know that the labor market is strong. We know that there's going to be an additional tailwind from lower rates, and even lower oil prices are one more plus for the consumer. So if the virus starts to peak in the next few weeks, we do think we'll see the market respond.
Russ, what do you think's been discounted at the moment in the bond market and also in the equity market? And is there a disconnect at the moment between the two?
I think it's a great question. I mean, look, with the bond market with yields at 70 basis points, you're starting to discount an awful lot of bad news. And there are structural reasons for it. This is coming after a multi-year run in bonds and demographic tailwinds and a lack of supply. But nevertheless, the collapse in real yields that we've seen, in addition, the run-up in gold, the run-up in the yen tells me that there's an awful lot of fear in the market. Now, I think that's partly been reflected in equity markets. It doesn't mean, obviously, that equity markets can't go lower if I don't think valuations themselves provide a floor. But we are seeing a lot of fear reflected in the hedges, with Treasury yields being the best example of that.
Russ, what do you guys think makes the market stop going down at this point?
I think it's a couple of things. I mean, look, obviously in the past, action by officials, particularly the central bank, have been the pivot. That's what stemmed the bleeding in late 18, but I think this is different. And the reason it's different is that the reason the market was correcting in 18 was because of tighter financial conditions. And when financial conditions looked like they were going to ease, stocks rallied. Unfortunately, I think it's harder this time because the source of the correction, the catalyst, is something that's very unusual. So what do you need? You probably need a couple of things. You need to see more of a coordinated effort by governments about how they're going to backstop different industries, how they're going to backstop some of the issues around supply chains. And obviously the best thing that would happen is some rate of deceleration in the virus itself. And hopefully we'll start to see that as we get into the spring in a few weeks.
Russ, just quickly, long term, would you buy bonds?
Long term, I think bonds have a part to play in the portfolio, but I think the yields at this level are challenging. But what I would also say is I wouldn't be rushing to sell bonds because, as we've seen, and we all would have thought that 2 weeks ago that bond yields were ridiculously low, bonds continue to work as a hedge when the biggest fear that everyone has is the economy may be falling off a cliff. So I wouldn't be rushing out to buy them, but nor would I be selling them here either.